Happy Friday, IHMC friends and family. It's Shayan with Integrity Home Mortgage, back with your weekly mortgage market commentary. So mortgage rates have fluctuated this week, which is kind of par for the course in this high volatility environment we've been stuck in for many months now. A combination of positives and negative headlines have rates trending lower midweek, but they are ending on a negative note with rates higher by, we'll call it 6 to 8 basis points today. Let's start with the positives. So this week's inflation data was benign and came in below expectations, pushing mortgage rates briefly down to their 6-week lows. CPI, which is a measure of consumer price inflation, and PPI, which is producer prices, still being seen as real numbers because it's still too early for them to be materially influenced by tariffs. And why is that important? Well, because that increases the likelihood that the Fed might view tariff impacts as being transient when they start to filter into the data over the next couple of months here. Transient meaning that it's a temporary sort of isolated impact, and the Fed should look past them when making long-term policy decisions. Also, mortgage application activity picked up sharply this week, up 12.5% week over week, which is logical given the more favorable rates. On the negative side, heightened geopolitical tensions in the Middle East as Israel and Iran have been trading missile strikes back and forth today. And that's been powering a flight to safety trade throughout global markets. This flight to safety trade is pushing oil higher and gold higher, but unlike it normally happens, it's not really benefiting bond markets today. And why is that? Well, partially because investors are trying to kind of unpack what it might mean for spending and the debt and the deficit if the U.S. gets dragged into a wider conflict in the Middle East, but also because this rise in oil prices are yet one more thing to elevate inflation fears. Also, trade talks between the U.S. and China this week resulted in a framework deal. There's a lot of details still to be worked out, of course, but it's a notable step forward towards de-escalating U.S.-China trade relations. Now, that sounds like good news, actually, but remember, in this environment where bad news for the economy equals good news for interest rates, the opposite is also true. Looking forward to next week. It's a holiday shortened week due to Juneteenth on Thursday, which will impact liquidity and could create a little extra volatility, especially on Wednesday and Friday. The big event, of course, being the Fed meeting. Markets fully expect the Fed will once again leave rates unchanged and stick to their wait and see approach. Decent inflation data from this week and favorable jobs data from last week are giving them the freedom to do so. This Fed meeting comes with an updated summary of economic projections, which we normally call the dot plots, which is a highlight of how voting members of the Fed forecast rates and economic activity will unfold over the short, medium, and longer term. The dot plots are what markets will react to next week, and they'll also drive the majority of the questions during Powell's press conference. Markets continue to price in 2 cuts this year, beginning in September, meaning that we should get 2 cuts in the final 3 meetings of 2025. If these dot plot forecasts line up with those expectations, we should stay within the current range on rates. Less and rates will push higher, more and they'll go lower. That's all I got for this week, folks. Have a great weekend, and we will see you next time.